Hi, and welcome to another presentation from your business tutor, learning your way, anytime, anywhere. Sir Richard Branson once said that an organisation should never take its eye off its cash flow because it's the lifeblood of business. What he was saying is that without enough cash, a business will fail. So with that point made, let's turn to today's presentation and explore the importance of cash budgeting. So what are we going to learn in this presentation? Well, first of all, we're going to find out what a cash budget is. We're then going to look into why organisations prepare cash budgets. And then finally, we're going to explore how cash budget problems occur and how they can be solved. Before getting into the heart of cash budgeting, it is probably worthwhile to ask why cash is so important to a business. Cash is so important to a business because it is used to pay all its bills, costs and expenses such as staff wages, rent, loan repayments and purchase of inventory. As is obvious, it is essential a business has enough cash to pay its costs because if it doesn't, staff may refuse to work or suppliers may stop delivering inventory. The eventual outcome of this is clear. If a business runs out of cash, also called being illiquid, it will become bankrupt and fail. On the other hand, should it have plenty of cash, termed being liquid, it will be able to pay its bills and still have cash left over to grow the business. This is why cash is so important, because it is the lubricant that keeps a business running smoothly, and this is why cash is so often described as being king. Okay, let's now move on to our next question and ask, what is a cash budget? A cash budget is a plan that shows what cash is expected to come in and out of a business over a future time period. In other words, it is a forecast of how much cash a business expects to have over the next few months. For example, over the first month in the cash budget shown, it can be seen that the business expects to have an opening cash balance on day one of zero, and then during the month anticipates £200 worth of cash will be received, whereas £205 will be paid out. This means that at the end of the month, as the closing balance shows, that the business is predicting a cash deficit of -£5. In other words, it won't have enough money to pay all of its bills. It will have run out of cash and it will become illiquid. However, as the business moves into month two, it can be seen that although the opening balance carried forward from the end of the first month is -£5, that as the business expects to receive £230 worth of cash and only anticipates £220 will be paid out, that by the end of month two, the business believes it will have a cash surplus of £5, meaning it will be able to pay all its bills and still have a little left over. In fact, as the business moves into month three, it expects that its cash position will improve further as the opening balance of £5 is supplemented with cash coming in of £240, whereas only £220 is expected to be paid out. This means that at the end of the 3-month forecast period, that the business predicts it will have a cash surplus of £25, meaning it will be comfortably able to pay its bills and still have a good sum left over to cover emergencies or to grow the business. Okay, before moving on, it is important to realise that the cash budget we have looked at so far has been simplified. In reality, when a business prepares a cash budget, it will include individual items such as sales that generate cash and purchases and wages which cash will be used to pay. In fact, this can be seen in a more detailed version of the cash budget we have just been looking at, where individual cash receipts and payments have been listed. Okay, let's now move on and ask, why do organisations prepare cash budgets. Cash, as has already been emphasised, is the lifeblood of a business, because without it, an organisation won't be able to pay its bills as they fall due. This is so important because if a business can't pay its staff, they will refuse to work, and if they can't pay their suppliers, they will stop providing inventory. Clearly, such a situation would be terminal for a business, meaning it is absolutely vital that a business ensures it has enough cash. This is why preparing a cash budget is vital, because as can be seen, it allows a business to identify cash shortages before they occur. Obviously, having such information is really useful as it gives a business time to solve the problem before it affects it. For example, by arranging an overdraft with their bank so that they can pay all their bills. However, a cash budget can also help in the opposite situation as well, in that it can help identify cash surpluses that are expected to occur in the future. This is useful as it then gives a business time to prepare how it could use this extra cash, for example, to purchase new equipment to help grow its business. Another reason cash budgets are useful is that they can be used to compare to what actually happens, which in this instance shows that the actual situation was a lot better than anticipated. This is useful for a couple of reasons. First, differences between the budget and the actual situation can be investigated to discover reasons behind why the plan was wrong. This then leads to the second benefit, in that if an issue is found, it may lead to more accurate budgeting in the future, as management learn from the mistakes they have made previously. For example, they may identify from their investigation that when they run an advertising campaign, that sales are more likely to rise by 20% rather than the 10% they had predicted. Of course, preparing an accurate cash budget also has a further benefit in that it can support good decision making. For example, in the cash budget shown, it can be seen that the purchase of new machinery would cause a cash deficit of minus £175 to occur. This is important to know as it tells management that purchasing new machinery in this way would not be viable and would result in business failure. However, if the business financed the purchase in a different way, for example by arranging a bank loan as shown, then the new machinery could be bought without making the business become illiquid. This therefore brings us onto a linked benefit of preparing a cash budget, and that is that a bank will want to see one before lending any money. This is because, as the example shows, the bank will be able to see that if they lend money, the business will be able to repay them without becoming illiquid. And finally, preparing a cash budget can make managers and departments more financially disciplined. If they know that their actual performance will be judged against the budget, they will be keen to make sure that they do not overspend, as this will show they have not done a very good job. Cash budgets, therefore, can act as targets which encourage managers and departments to spend prudently and sensibly. Okay, let's now move on to explore how cash budget problems occur and how they are solved. To solve a cash budget problem, it is first sensible to find out what caused it in the first place, as this often gives an insight into possible solutions. So let's do that by looking at a cash budget which shows that purchase costs, highlighted in purple, are expected to rise throughout the 3-month period, which, coupled with the fact that the cash coming in from sales revenue remains static at £200 every month. And you can see why in months 2 and 3 the business experiences cash deficits. Okay, so now we know the problem is increased purchase costs. It would seem that the simple solution would be to find a cheaper supplier and purchase from them instead, as this would decrease the amount of cash leaving the business. However, if it is discovered that the business's current supplier is the cheapest, a different solution would be needed. For example, in the cash budget shown, the organisation has increased their selling price, highlighted in blue, so that more revenue is generated from sales. Of course, this will only work if the same number of customers continue to buy the product at the higher price. Another issue that can cause a cash budget problem is when a business wants to purchase an asset such as a delivery van or new machinery. Because as can be seen, its purchase in month 1 causes a cash deficit that carries on into months 2 and 3. Now, in simple terms, this problem could be solved by not purchasing the delivery van or saving up for it over a few months. However, in reality, both these solutions may be impractical, as the business may require the delivery van immediately to carry out its business. As such, a better solution would be to hire or lease the vehicle instead, as this would mean only a small, affordable monthly payment would have to be made, instead of having to pay out a huge lump sum in one go. However, should the business wish to own and purchase the delivery van, it may instead decide to take out a bank loan for £50, which it would then repay in affordable monthly instalments of £5, which, as can be seen, would allow the business to maintain a cash surplus and therefore would keep the business liquid. A third issue that can cause a cash budget problem is rising expenses. For example, in the cash budget shown, it can be seen that both advertising costs and staff wages are rising month on month, which eventually leads to a cash shortage in month 3. This issue is of course easily resolved by the business cutting its expenses. For example, wage costs could be reduced by giving staff fewer hours or getting rid of staff who are not required, whereas advertising costs could be reduced by either not advertising as much or finding a cheaper way to advertise, for example by using social media. If this is done as the cash budget shows, a positive cash surplus will be maintained over the 3-month period by controlling business expenses more effectively. In fact, managing expenses is an extremely important aspect in ensuring a positive cash position is maintained by a business. This is why managers will often investigate other ways to reduce expenses by finding a cheaper electricity supplier or will negotiate with their landlord for cheaper rent on their premises. However, as effective as these measures can be in reducing the amount of cash leaving a business, a manager also needs to keep their eye on the other side of the budget, that being increasing the cash coming in. For example, a business's cash position could be improved by convincing more shops to stock their product, which of course would increase sales, or by running an advertising campaign, which although costs money, could result in a far bigger rise in sales and therefore an improvement in the business's cash position. Alternatively, a business may look to raise additional cash by selling old assets it no longer needs to improve its liquidity position. Okay, let's now move on to a couple of more complicated ways in which cash budget problems can occur, by first looking at offering credit to customers. This technique, which is often used by businesses to encourage sales as customers can buy today but pay later, can, however, as the cash budget demonstrates, cause cash flow problems. Because as the business is now selling on credit, it has to wait a month for customers to pay, meaning no money is received in month 1, even though suppliers and other expenses still have to be paid. Nevertheless, although this problem looks severe, it can be solved in a number of ways. For example, the bank could provide an overdraft or the business could negotiate credit terms with their supplier, meaning they won't have to pay them until month 2 when their customers pay them. However, in this instance, as the cash budget shows, the business sells the monthly value of its credit customers' accounts to a debt factoring business to obtain immediate cash in month 1 and thereafter of £220 so as to avoid a cash deficit. And finally, another classic cash flow problem can be caused by what is referred to as overtrading, when a business takes on too much work or tries to grow too quickly. In both situations, the business experiences cash shortages because they have to shell out a lot of cash up front in order that they can get the work they've taken on started. For example, on such things as purchasing additional inventory, paying staff wages, or renting new premises. However, all these payments need to be made before they've received any money from their customers. Of course, although this problem can be terminal, by using cash budgets, a business will be able to identify the problem before it occurs, meaning appropriate finance, such as a bank overdraft, can be put in place to ensure the business has enough cash until money starts to come in from customers. Okay, let's now move on to our final question, which is, what impact can poor cash flow have on a business? As has been shown, cash is incredibly important to the effective running of a business. Nevertheless, even though this is the case, many organisations do get into cash flow problems, which can have a huge effect upon their viability. For example, not having enough cash may mean that suppliers cannot be paid, resulting in them refusing to deliver stock, which of course will result in understocking and not having enough inventory to meet customer demand. Alternatively, a lack of cash may mean that a business has to arrange emergency sources of finance, which can be very expensive, as the interest rate charged on them will be high. Equally, a lack of cash also means that an organisation won't have any money to invest in growing their business or purchasing new technology, which means they will find it incredibly hard to compete in the marketplace against larger competitors that are investing in their businesses. Further still, in order to generate cash quickly to overcome a cash deficit, a business may have to offer discounts to customers that pay in cash or to encourage credit customers to pay sooner. In both these instances, the business will be selling its products at a lower price, which will reduce their profits. Another issue associated with poor cash flow is that shareholder dividend payments may need to be reduced or even cancelled, which obviously may result in some shareholders selling their shares and the company's share price falling. On the other hand, poor liquidity could result in a business having to slash its costs. For example, by sacking staff, which obviously would have a negative effect on not just motivation, but also the culture of the organisation too. And of course, in the end, if an organisation is unable to resolve its cash flow problems, the inevitable will occur: bankruptcy and business failure. Okay, so what did we learn in this presentation? Well, first of all, we found out what a cash budget is. Then we went on to investigate why organisations prepare cash budgets. And then finally, we explored how cash budget problems occur and how they can be solved. There is no doubt that cash is incredibly important in business, and that cash budgets are an effective way of managing a business's cash position. This is especially the case for organisations that are struggling to generate enough money to pay their bills. Because if there is one thing that will bring a business down, it is a lack of cash. This is why cash is, and always will be, king.